At this moment, we can look at a question on how to tax a sole proprietor. So here is the question. I'll read and then I'm going to show you how the tax is usually determined. This is what the question says. Lois Rubandi is a sole trader operating as Lois Traders. She did not maintain proper accounting records but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. We have the summary of cash transaction for the year ending that 1st December 2015. We have the receipts, balance brought down, trade receivable, cash sales, commission received, capital. We go to the side of the payments, trade payables, cash purchase, salaries and wages, rates and insurance, medical bill for self, transport, bank charges, general expenses, loan interest, new motor vehicle, drawings. Summary of assets and liability as at January 2015 and that 1st December 2015. We have as at January 2015, as at that 1st December 2015. We have furniture, written down value, motor vehicle, written down value, trade payable, inventory, trade receivable, salaries and wages, due, prepaid rates, commission received in advance, capital. Additional information. Number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. During the year, she took goods for free from the business worth 100,000 for her own use. Depreciation was ascertained as follows: motor vehicle 25% per annum on book value, furniture 12.5% per annum on book value. Bad debts written off during the year amounted to 72,000. Required taxable income for Lois Rubandi for the year 2015 and the tax payable, if any, by Lois Rubandi. So we are supposed to, number 1, required, we get the taxable income of Lois Rubandi. So we said, whenever you are told to get the taxable income, first thing that you normally ask yourself, which approach am I supposed to use whenever you are taxing a business? Is it the gross profit? Is it the net profit method? From the question, we said net profit method is used when net accounting profit or loss or income is provided. From the question, there is nothing like that. And so if it is not there, so the first thing is to check if there is net accounting profit or loss or income provided. If it is not, then it is not provided, then automatically we use the gross profit method. Gross profit method, we said, we usually start with the sales. We rest the cost of sales. We know, you can remember how we said you get cost of sales: opening stock plus purchases less closing stock minus any item that reduced the stock during the year. We get the cost of sales. Then sales minus cost of sales, we get gross profit. Then we add taxable operating income. We list them, and then we list the allowable expenses. We list them. Now, and then we compare. We take gross profit plus incomes minus allowable expenses. But we say that before you do any question on the gross profit, determine the first item that you are supposed to use, the sales. Have you been given the total sales? If not, then the first thing that you do, you have to determine the total sales. 2, have you been given the total purchases? If not, then you have to determine the total purchases so that you can prepare the statement. So in this case, we ask ourselves, have you been given the total sales? In the question, we are only given the cash sales. But just above the cashes in the summary of cash transaction, there is trade receivable, telling you that there was some evidence we sold on credit. So how much did we sell on credit? So that we add to the cash to get the total. We said if you are not given the credit sales, you have to open the debtors or receivable account to determine it. Then you add to the cash sales, then you get the total sales. 2, have you been given the total purchases? If you haven't been given, then you have to determine. In this case, have we been given? No. We are only given one part of this purchases, the cash purchase. So, but were there some evidence there were some credit purchase? Yes. Just above the cash purchase, there is the trade payable. What does that mean? We had purchased on credit. So we have to determine the credit purchase. We add the cash purchase so that we can get the total purchase so that we can use it. So this is how you go about it to determine the total sales and total purchases. We say total sales is equals to the credit sales plus cash sales. the best way to do, you see the cash sales we have been given. What we need to find is the credit sales. Now leave a space here. When you're doing it on your own, leave like 1 or 2 lines here, where now you'll be posting the figures. When you get the credit sales, where you post the cash sales, where you post, so that when you add the two, you get the total. Then for you to be able to get the credit sales, we said you open the debtors or receivables account. So you come here after the 2 lines or so, debtors or receivable account. What you do once you open that account, balance at the beginning of the period, write it there. This is the debtors at the beginning, but don't look for it. No, you are just preparing a structure to help you to get the credit sales. Then you jump. The best way is to jump like 5 lines here, 5 or 4, and then the balance at the end, as we had said when we introduced to the taxation of the business, balance carried down for the debtors, you'll post them here, debtors, you'll post them, but don't look for them. It's just a structure. Then these lines represent where we'll post the totals, but now balance at the end we'll post here. And then we come to the purchases. We haven't been given the total of purchases. How do we get it? So we say total purchases is equals to credit purchases plus cash purchases. Now, as we have seen, we have even been given the cash purchase. So what we need to find is the credit purchase. To get the credit purchase, we open the creditors or payables account. Same case, we jump like 2 or 1 line here. Then you open the creditors or payables account. Now for the creditors, we start with balance at the beginning of the period here, balance brought down, that is for the creditors there. Then jump like 4 or 5 lines as we said with the other one, and then have the balance carried down for the creditors here. Then at the end you'll get the total. In this case, what we normally do, we go through the whole question. If we come across a cash sales, we'll post here. If we come across something that affects the debtors or receivable here, if it increased the debtors as we had said initially on this side, if it reduced the debtors on this side, then we come to the creditors. If we come across something that affects the cash purchase here, if it affects the creditors, increase the creditors being a liability, we post it on this side. Creditor, if there is any information that reduces the creditors, you put on this side, because as liability they reduce, you normally post them on this side. So let us go through the question and find out if there is any of such item. We start with the first paragraph. Don't ignore anything. We are told Lois Rubandi is a sole trader. She did not maintain proper accounting records, but has provided the following information relating to her income and expenditure for the year ending that 1st December 2015. There is no information that affects these items here, so ignore. Summary of the cash transaction for the year ending that 1st December 2015. We start with the debit. There is the receipt. On the side of the receipt, we have the balance brought down. Balance brought down at that point, it is the cash at the beginning. Cash at the beginning, we ignore. That doesn't affect. The next one is the trade receivable. So trade receivable, we have it here. And we can see it is on the receipt side, meaning we got money from the trade receivable. Trade receivables are debtors paid. When debtors pay, it reduces the debtors. So we post it on this side. So receipt. They have paid. And they paid 1226,200. 1226,200. After that, there is cash sales. Cash sales, just below the cash sales that we have here, 5620,000. paste it there. After that, commission received, that doesn't affect. The other one is capital. Capital doesn't affect. We go to the payment side, trade payables. If you have trade payables on the payment side, that means that they paid their payables. So meaning payables reduced. When payables reduced, you post on the debit side. So you come here, payment, which we have 1,005, 200. Then we continue cash purchase. Cash purchase, just below the cash purchase where I told you to leave some space, 1620. 800. Then after that, salaries and wages, that doesn't affect. Rates and insurance doesn't. Medical bill for self doesn't. Transport doesn't. Bank charges, no. General expenses, no. Loan interest, no. New motor vehicle, no. Drawings, no. That's the drawings of cash. Then we go to the summary of assets and liability as at January 2015 and December 2015. We have furniture's written on value, no. Motor vehicle, no. Trade payables, yes. Here we have the balance at the beginning for trade payable, 985,000. 985,000. And the other one at the end is 1180,000. So 1180,000. After that, we have the inventory, no. Trade receivables, yes. At the beginning, 781 here. 781,000. Then at the end, 821,400 here. Now that is the time that you're supposed to post when you come across the figures or the items. Then salaries and wages due, prepaid rate, no. Commission received in advance, no. That doesn't affect. Capital, no. Additional information, number 1, discount allowed and discount received during the year amounted to 5,600 and 151,200 respectively. Now, discount allowed reduces the debtors. When you give debtors discount allowed, it reduces what they are supposed to pay you. So you come here, discount allowed. So discount allowed, which we have 5,600. And then we have discount received. Discount received, you receive from the creditors, people you owe money. So you'll have here discount received. Discount received, which we have 151,200 there. Then we continue. Number 2, during the year she took goods for free from the business worth 100,000 for her own use. That does not affect any one of this. She just took goods from the business for her own use. Doesn't affect. Then number 3, depreciation was sustained as follows. Depreciation does not affect any one of this one. We go to number 4. Bad debt written off during the year amounted to 72,000. Bad debt does. So bad debt is usually from the debtors. That some people who have refused to pay and you have written them off. When you write them off, it means that it reduces what you are demanding from them. So we have it here. Bad debts written off. Bad debts written off, which you have 72,000. 72,000. Now you note that is the end of the question. Now what you do is to do the summation. Now we start with the debtors or receivable account. We want to know how much was the credit sales, which is supposed to be the balancing figure. The balancing figure. How do you do that? Take the totals on this side and write them here. We have 12, 26,200, and then we add 5,600, and then we add 72,000, and then we add 821,400, which we get 21,7,200. Then this one should be the same as on this side, 21,7,200. Then the difference between this figure and what we have posted on this side, if we had like 3, this one and the other 2, the difference is the one that we post here as the balancing figure, but we only have 1. So we minus 781,000, which gives us 1389 1389,200. Now that we have the credit sales, we transfer here. So 1389,200, and then we now add the cash sales to get the total sales. So we add the cash sales, which is 5620,000, and then 5620,000, which give us 7,009,200. There. Now we come to the creditors. We want to get the credit purchase, which is supposed to be the balancing figure. We take the totals on this side, which is 1,005,200, and then we add 151,200, and then we add 1180,000, and then total, which is 23,36,400. Then we'll have the same here, 23,36,400. Then we minus the totals on this side. On this, we only have one for now. If we had two figures, the three, we could have minused them. So 90,85,000, which gives us 13,51,400. There. We have the credit purchase. Now we can transfer the credit purchase here, 13,51,400, add the cash purchase. So we add cash purchase of 1620,800. 1620,800, which give us 29,72,200. There. Now we have our total purchases and our total sales. From there, we can prepare the statement. So we come here, the name of the business, it is the Lloyd Traders. So we come here, Lloyd Traders, sole proprietor, taxable income, for the year ended, that 1st December 2015. So we'll have a column where we'll be posting the figures. And as we had said about the gross profit method, we start with sales, of which case now sales is the one that we have determined here, 7,009,200, and then we less cost of sales. For the cost of sales, we start with opening stock. Opening stock is in the summary of the assets and liabilities. Inventory at the beginning, 1241,600, plus the purchases. The purchases is the one that we determined here, the 2972. 2972,200. We minus the closing stock. Closing stock, which we have 14,8600. And then remember to minus any item that reduced the stock during the year. And we say items that reduce the stock during the year are like damaged, stolen, withdrawn stock. For this question, we only had one place. Number 2. During the year, she took goods for free for the business worth 100 for her own use. And they are goods. They must be goods, not cash or when silent. When silent, just ignore. Because in that case, you cannot assume they are goods. Only when they are goods or inventory that they do or we do come and deduct them here. So she withdrew 100,000. Now, having no other, we close the bracket and get the total. The total, that is the net, 1241 is 600, and then we add 2972, 2972 200, 2972 200, and then we minus 1480 600, and then we minus 100, which we get 26 33 200. And that will give us the gross profit. So gross profit, which would be, we take 7,000 9,200, and then we minus that figure, which give us 4376,000. After that, we usually add other taxable operating incomes. Now, the best way to do it, instead now for you to go and look for the taxable operating income which you list here. Remember, we had looked at the topic on the on an area on taxation of operating income or taxable operating income. Now, instead of looking for them, it will be a waste of time. The best way is leave a space of like 3 or 4 lines here, and then now less. Remember, in the statement when you're using the gross profit, we said once you add the taxable operating income, you less allowable expenses. So you have left 3 or 4 lines, and then now you have less allowable expense. I want to underline because these are headings of the figures that will be posting, or the items that will be posting of the taxable operating income here and allowable expenses here. We need to go through the question, look for a taxable operating income which will be posting here, allowable expense here. We start from the summary of cash transaction because up there in the first paragraph there's nothing. The first under receipts balance brought down, we say that's the cash at the beginning of the period. We ignore. It is not an income. It's just a cash we had when we were starting the period. Trade receivable, that we used it to get our debtors here, our sales here. The other one is cash sales. It was used to get the sales. Commission received. Commission is an operating income, not an investment, and it is a taxable operating income. Now, having gotten the commission, what you do is this. Check around if there is any other place that commission has been mentioned. If you go to the summary of assets and liability, there is another commission received in advance. So what do? When you have it, somewhere else it has been mentioned, have commission income here. Then open a bracket of the information given. If something increases the item like commission, add. If it reduces the commission, less. Like now, and also, if the commission is relating to this year, you add. If it is relating to another year, you minus. That's simple logic. Anything for this year, you add. Anything for another year, you minus. Like if we start with the commission received, you see it is that in the transaction for this year, commission received in the year, it is for this year. So we add. We add 124,000. Then, in the summary of assets and liability, commission received in advance, and we have at the beginning and at the end. Now, if you receive commission in advance when you are starting the year, ask yourself, you are receiving it in advance for which year? Don't look at when it was received. Look at it is relating to which year. When you receive it in advance at the beginning, it is for this year. The year we are taxing, like in this case, it is the year 2015. Received in advance in January, it is for the current year. Yes, it was received last year Yeah, because it was received in advance by the beginning. It must have been received last year, but it is for the current year. Anything for this year, we add. That's what we have said. So we have 80,000. Then commission received in advance at the end of the year. When you receive commission at the end in December, it must have been for the following year. So not this year, for the other year. So in that case, we minus 136. So we need to compute the net. So we say plus 124,000 and then plus 80 and then minus 136, which give us 68,000. 68,000. Then we go back to where we found that commission. We found it in the summary of cash transaction for the year. Then continue from there. Don't jump anything. Consider everything provided. After commission, there is capital. Capital, yes, it is not even an income, because capital, it is what the owner introduced into the business to assist him to run the business, you know. So that's not an income, and it's not even an expense. We go to the payment side. Trade payables, we used that to get the purchases. Cash purchase, we used it here. Salaries and wages, that is an expense. And salaries and wages, we said, is a allowable expense. Unless it relates to the owner, it is allowable. So we'll have here salaries and wages. But as we said, before you post it, check if it is mentioned somewhere else. It is mentioned in the summary of assets and liability. Almost in the middle, there is salaries and wages due. Higher, we have to adjust it the way we said. We start with the one that was paid in this year. If it was paid in this year, it must be for this year. We add 1660, 400. Then we go to the summary of assets and liability. Salaries and wages due at the beginning. Due at the beginning, it must have been for last year, because it is what the arrears that were supposed to be paid last year, but they were not paid. So which year are they relating to? It is last year. Yes, they will be paid this year. Actually, they are in this 1660,400, you know, because it's arrears for last year. They must have been paid here, but they are not relating to this year. The workers offered the service last year, only that they were not paid. So since it is not for this year, minus, and we minus the 184,000. And then we have salaries and wages due at the end of the current year. At the end of the current year, that is for this year now, because it is workers offered the service this year, only that we didn't have money to pay them by the end of the year, but they rendered the service this year. So the income was generated, the one they assisted to generate was for this year. That one we add. We add 150,000. Now, because there's nowhere else we have salary being mentioned, we can get the net. So 1660, 400, and then we minus 184,000, and then now we add 150,000. So in this case, we get 1626, 400, which we minus. And it's also important for me to mention that this one we normally do it this way, instead of opening the salaries and wages account or even the commission account where you try to get for commission for this year, the one that you bring here, or this, it will give you the same, but that's a long process. It's a wastage of time. Just do it this way. Then we go back to where we found the salary. After the salaries and wages, there is rates and insurance in the cash transaction. Rates and insurance, that's allowable because they are for the business. They are allowable expenses. So we'll come here, rates and insurance. Now, we check if it is mentioned somewhere else, that rates and insurance. Yes. If you go to the summary of assets and liability, there is prepaid rates, that last item. So we have to open a bracket there. And we start with the rates and insurance in that year. The one that was paid, it is for that year. We add. And we add 320,800. 320,800. Now, when you come to the prepaid at the beginning, You see, when you are starting the year, January, and you have a prepayment, that must have been for the current year. You are prepaying for the current year. That we add. We add 50,000. And when now you get to the end of the year and you have a prepayment, you are prepaying for the following year, which means whatever you paid this year, part of it was for next year, that one you minus. So we minus 72,000. Having no other place it has been mentioned, we get the net, which will be 320, 800, and then we add 50,000, and then we minus 72,000, which give us 298,800. Yeah. We go back to where we found that rate and insurance in the cash summary. After rate and insurance, medical bill. Medical bill is allowable, but the problem this time is for self. And we said here, when you are taxing a sole proprietor, any expense relating to the owner, private expense, we don't allow. This we even said when you are looking at the general allowable and non-allowable expense. And an non-allowable, anything to the owner, we don't allow. Private expenses. So that is not allowable. We won't deduct. The other one is transport. Transport is allowable and it isn't mentioned anywhere else. So transport, which you have 56,400. After transport, bank charges. Bank charges are also allowable. They are for business and they are not mentioned anywhere else. Bank charges, which we have 3,000. 3,000. After that, general expenses. General expenses are also allowable. There are small expenses that are put together for the business. General expenses. General expenses, which you have 145,400. The next one is loan interest. Loan interest, we said interest on money borrowed and invested in business is allowable. So loan interest, allowable. Amount, 120,000. After that, new motor vehicle. Fixed asset, we said we don't allow. We allow capital allowance. Of which case we said motor vehicle, capital allowance at the rate of 25%. Capital allowance, written in short as CA, motor vehicle, 25%. But check whether you have the balance at the beginning. We take the balance at the beginning. If you go to the summary of assets and liability, at the beginning we had a motor vehicle, 960, of which case will be 960. Then add the one that was purchased in that year, which was 600,000. With nothing more, get the amount. That will be 960,000 plus 600,000, giving us 1560,000 times 25%, which give us 390,000. We go back and continue. After the new motor vehicle, drawings. Drawings, we said they are private expense. They are for private use. We don't allow them. Then we go to the summary of assets and liability. Furniture. Furniture is a fixed asset. We claim capital allowance on it. So we'll have capital allowance on furniture and fitting, in short. So 10% off. We start the balance at the beginning, 120. And there was no addition of furniture. There is nowhere we are told about addition. So we just take 10% of 120, which gives us 12,000. After that, we go back. Summary of assets and liability for furniture. We have considered motor vehicle. We had considered already. It's there. Capital allowance. Trade payables, that's not an income, not an expense. Inventory, not an income, not an expense. Trade receivable, not an income, not an expense. Salaries and wages, we had considered. Prepaid rates, we had considered. Commission received in advance, we had considered because we had met them earlier. Capital, No, that's not an income or an expense. Additional information. Number 1, discount allowed and discount received during the year were 50,600 and 151,200. Discount allowed is an expense, and an allowable one will have discount allowed. Which we have 50,600. Then discount received 151,200. That is an income and a taxable one. We had said that when we were looking at the general taxable and non-taxable income. Discount received, a taxable operating income, 151,200. Then additional information number 2. During the year, she took goods for free from the business worth 100,000 for her own use. That's an expense, yes, but it's not usually allowable, we said, because it's for private use. Number 3, depreciation was ascertained as follows. Remember, we said depreciation is not allowable. What we allow are the capital allowance in taxation, which we have considered. So ignore. Depreciation is not allowed. Number 4, bad debts written off during the year amounted to 72,000. Trade bad debt written off are allowable. Unless we are told they are not relating to the trade, to the business, they are allowable. Bad debt. And take note, don't confuse with provision. Provision are the one that we say specific provision we allow, general provision we don't. Bad debt are bad debt, and they are allowable as long as they are relating to the business. Bad debt written off, which we have 72,000. Bad debt is the last item provided. So what do you do now? We are done. We now have to get, we come now to the end here. We get net taxable operating income. So from operation, how much is the total taxable income? That means that we take the gross profit plus this income minus the expenses, allowable expenses. We start with 43,76,000. Then we add 68,000. And then we add 151,200. And then we minus 1626,400. And then we minus 298,800. And then we minus 56,400. We minus 3,000. We minus 145,400. We minus 120,000. We minus that 390,000. We minus 12,000. We minus 5,600. Then we minus 72,000. It gives us 18,260,000. So what we do is this. This being a sole proprietorship business, we had said earlier on, we tax the sole proprietor on his or her own income. So once you get the net taxable operating, add taxable investment income. So you add taxable investment income. If operating income is positive like this one, if the operating income is negative, you carry it forward to next year to be deducted against the profit of next year. Remember we said we carry forward a loss up to a maximum of 10 years. Now, if you look at the question that we have, there is nowhere we are told about investment income for now. But if you had non-qualifying dividend, remember those are dividends which withholding tax is not final. Non-qualifying interest which withholding tax is not final. Royalty income for resident withholding tax is not final. Rental income for commercial buildings, for residential above 15 million per year, we should add them here. But for this question, we don't have, so we would have a dash. And so meaning we can now get total taxable income, which would be the same because the investment is 0, 18, 20, 600. And required number 1 ends there. Now we have the taxable income. What we had said, the first thing is to determine the taxable income. The second one now is to determine the tax payable. Criteria of determining the tax payable. Now we have to tax that income on that individual, and which we said that sole proprietor do not have separate legal entity from the business. So the income of the business is taxed on the owner. So how do we tax? We had said at graduated scale rates in the same way as employment income. So we want to look at how we tax that income. We are going to use the scale rate that was used in the year 2022. But the concept is the same. What happened is that if the rule changes, and the reason why we are looking at year 2022 because we are looking at the exam of December 2023, if the rule change, you find that the table just changed, but the concept of getting what you are, the computation is or remain the same. So I'm going to delete this part here so that we can see how we can tax the 18, 20, 600 to get the tax that is payable by this sole trader. So to come here, tax payable. So we want to get the tax payable. So if you look at the income that we have, it is 18,20,600. Now there is a table that is given by the examiner in an exam, or the question, as long as you are doing the question about tax, you will be given first page. And as we have said, we are using the table that was used in the year 2022, but it is relating to the year of income of 2021. But that's the one that we are going to use. So if you look at the top there, there's somewhere with the rates of tax, including wife employment income, self-employment income, and professional income's rates of tax. Year of income 2021. Assume that the following rates of tax were applied throughout the year of 2021. We have the monthly taxable pay, annual taxable pay, rates of tax. Because we are taxing an year income, not 1 month. It was for the year ending 2015, 1 year, we use the annual taxable pay, which start between 1 shilling to 288,000. The percentage is 10%. Between 288,001 to 388,000, 25%. Excess over 388,000, 30%. So if you look at the income that we have there, 18,20,600, that means that we go to the excess of 388. So we have to tax up to the rate of 30%. How do you start? You start with the first. Now at the rate of 10%, pick the last amount appearing in that range. Between 1 shilling to 288, pick 288. So the last amount appearing there. So we say first 288,000 times 10%. It gives you shillings here 28,800. Then you come to the next. The next, you take between 288,001 to 388, 25%. Now we don't pick the last amount and we tax at 25 like we have done for the first one. No. You take the difference between the last amount appearing there, which is 388,000, minus the last amount appearing in the previous rate. In the previous rate, the last amount is 288,000. So 388,000 minus 288,000 give you 100,000. So to come here, 100,000 times 25%, which gives you 25,000. 25,000. After that, we go to the excess over 388,000, which we tax at the rate of 30%. Excess over 388 means what? It means that we have already taxed 388. If you take 288 plus 100, that will be 388. So whatever is above 388, you tax at the rate of 30%. How much is that? So this we call it last. The last, which is now the total taxable amount, 18,20,600. You less what you have taxed. You have taxed 388. 288 plus 100, that will be 388. So this one, you multiply by 30%. the excess now. So let us get the excess first, which would be 1820 600 minus 388,000 gives you 1432,600. Then times 30%, which gives you 429,780. Then, because that is the last one, you add those taxes to get something called gross tax. Gross tax, which would be the 429,780 plus 25,000 plus 28,800, which gives you 483,580. That we call it gross tax. Now, after you get the gross tax, there are 3 items you are supposed to deduct here, which are called set off. They are the same that we talked about when we were looking at the employment income, only that we don't have pay as you earn. Pay as you earn is usually for a person who is on salary. This is just a person in business is not on salary, so we ignore. But now, personal relief is one of the set off we talked about, of which case personal relief is provided in the table. If you look at the table we have used to tax, just after the table there is personal relief per month 2,400. If you multiply by 12, you get per annum 28,800. The next one is called insurance relief, and we said this for a person who have education or life insurance cover or NHIF insurance cover, and I showed you how to compute. So if this individual had that, if this sole trader, that is a lorry trader, had the insurance life or education on NHIF, we could have claimed the insurance relief, but she didn't have, so we ignore. The other one is withholding tax on investment income, which withholding tax is not final. That means that you have to look at the investment income you have added here. If you had added something like non-qualifying dividend, remember there is a withholding tax of 15%. You'll come and say investment income, withholding tax 15% of the gross to remove it. But we didn't have. So for now, the only set off we have is the 28,800, and this will give us the net tax payable. The net tax payable, which will be the 483,580 you minus the 28,800, which gives us 454,780. And that answers required number 2, where we were supposed to get the tax payable by Lois Lubandi, and it ends there. For now, that is how we usually tax the sole proprietorship business. We end our lesson there. Until next time, when we are going to look at the taxation of the partnership. Thank you very much. Yours here, Patrick Kamau Kamure.